All right, let's talk TriNet. So you've got a company that, on paper, absolutely crushed its earnings. I mean, blew the numbers out of the water. But then you look at the stock, and it completely tanked. So what on earth is going on here? That's what we're going to unpack today.
So here's how we're going to break it down. First, we'll hit those crazy headline numbers. Then we'll dig a little deeper to see what the market was so spooked about. We'll zoom out for the big picture, and finally, I'll give you our take on what to look for next.
Okay, so Section 1, the headlines. And really, this is a classic beat and drop situation. You look at the numbers and you think, wow, this stock has got to be flying. But, as you'll see, that's not what happened. Not even close.
Just look at this. The company posts adjusted earnings per share of $1.11. You know what the street was looking for? 72 cents. That's not just a beat, that is a crushing beat. We're talking more than 50% above expectations. That should be a massive green flag, right? It signals they're running the business really, really well.
And yet, this happened. The stock closes down over 8% on the day. It even had a little pop in the pre-market, and then just wham, a total sell-off. So this is the puzzle we have to solve. Why did such fantastic news get such an awful reception from investors?
All right, to figure that out, we've got to go beneath the surface. This is where things get really interesting, because you have two completely different stories being told. On one hand, you have management sounding super confident, and on the other, you have the market looking at the numbers and getting really, really nervous.
Let's listen to management's side first. You've got the CEO, Mike Simons, on the call basically saying, hey, everything's going great. Our outlook is improving. Our confidence is growing. He's painting this picture of a company that's executing its plan perfectly and setting itself up for long-term success. This is the story they're selling.
And here's the core of that conflict, right here. The bull case, management story, is all about the good stuff. They finished a tough but necessary benefit repricing, they're disciplined on costs, they're on track for the high end of their profit guidance, and hey, they've got a new AI product and a new CFO coming in. Sounds pretty good. But then you look at the bear case, the stuff the market actually cared about, and it's ugly. The number of employees they service down, revenue's down, the small business environment is tough, and they didn't even raise their guidance. That's a lot of red flags.
So let's just double-click on that WSE thing for a second. It stands for worksite employees, and for a company like TriNet, this is the metric. Think of them as the outsourced HR department for tons of small businesses. So WSEs is just the total number of people they're serving. It's their customer count, plain and simple. And when that number is down 6%, well, that's not just a red flag. That's a blaring siren telling you their customer base is getting smaller.
And then there's the guidance. This was a real head-scratcher for Wall Street. Management is saying, yeah, we're on track to hit the high end of our profit forecasts, but in the same breath, they don't actually raise the forecast. You know, to an analyst, that feels off. It's like saying you're acing the class, but you're not sure you'll pass the final. It signals that maybe they're not so confident about what's coming next. The Q&A with analysts really brought all this out. Management's defense was, look, we're just ahead of the curve on repricing our health plans, and it's tough right now. But they couldn't hide the facts. The small business world is sluggish. They had to pause their own sales hiring earlier. It just paints this picture of a company that's doing a great job managing the things it can control, but it's getting hit by some serious headwinds it can't.
Okay, so let's pull back for a second and look at the big picture, because this one quarter didn't happen in a vacuum. To really get why investors are so jumpy, you have to see how this stock has been performing.
And wow, this chart says it all, doesn't it? Over the last year, while the S&P 500 is up almost 15%, TriNet is down nearly 40%. That is a massive, massive underperformance. So when you have a track record like that, investors have absolutely zero patience. They don't want to hear excuses. They want to see growth, period. So here's what it all boils down to. TriNet is making a choice, a really tough one. They're basically saying we're going to sacrifice some customers in the short term by raising prices so we can fix our profitability and be healthier for the long run. It's a short-term pain for long-term gain strategy. The big question is, will it work? And right now, the market is saying, we're not so sure.
All right, so where do we go from here? What are we looking for in the next earnings call? Well, this has officially become what we call a show-me story. The talk is over. Management has laid out their plan. Now they have to deliver the goods.
So our official rating on the stock right now is market perform, and here's why. It really reflects the two sides of this coin. On one hand, they're doing an amazing job with cost control and getting their margins back in shape. That puts a bit of a floor under the stock. But you just can't get away from that top-line growth problem. It's the elephant in the room.
So moving forward, here's what's on our checklist.
Number one, and this is by far the most important, we need to see those WSE numbers stop bleeding. Even just flat would be a huge win. Then, we'll be looking for any early signs that their new AI tools are getting traction. We want to hear from the new CFO about her strategy. And of course, we're all waiting for that first glimpse of guidance for 2026. Oh, and keeping an eye on the overall health of small businesses is a must.
So that brings us to the big question, right? Is there a way to trade this? How would an analyst actually think about this setup? And believe it or not, we think there's a pretty interesting, though definitely risky, contrarian play here. Okay, so here's the pitch. The whole idea is that expectations are now in the gutter. The market is pricing the stock as if the WSE numbers will keep falling forever, so the bar for good news is incredibly low. If they can just show any sign of stabilization that the bleeding has stopped, the entire story changes overnight. It goes from a company in decline to a turnaround story, and that could cause a huge pop in the stock. So how do you play it? You could look at some long-dated call options, maybe for early 2026, to give the story time to play out. Now let's be crystal clear, this is a high-risk, high-reward idea. There's a very real chance those options expire worthless if things don't get better, but if the turnaround starts to happen, the upside could be significant.
And of course, we have to say it. This is not financial advice.